All right. Well, let's just get going. Jason, Emily, my co-host. Hey, I got a bone to pick with you real quick before we get going.
What?
I didn't bring this up before we hit record, but
I'm a little worried, to be honest with you.
So as I was editing the last episode,
Okay.
I introduced you again as my co-host. And you're like, hey, thanks for having me. I'm like, this is your podcast, man. We are a team on this.
Okay.
So I never want to hear thanks for having me again on this show.
All right.
All right.
Yep.
So
Gotcha.
When we hear thanks for having me, it's when we have other guests.
That would be
not
true.
the co-host.
Okay.
Just want to make that clear to anybody. This is not my podcast. This is our podcast. So, hey, today we're going to actually get into the nitty-gritty about how to use an IBC whole life policy in real world terms. We're going to talk about how you and your wife bought a vehicle with the policy and everything like that. So I was kind of going through, just doing a little bit of research, and I want to make sure that people understand that interest rate really doesn't matter. That's what everybody focuses on, but it's not. The banks want you to focus on interest rate, but they know there's a different game that they're playing, and I just want to hit on it real quick. So in 2024, the average car loan was roughly $41,000, okay, at roughly 8.5% interest rate, all right? So let's say that you have a car loan at that average, and you take it out 60 months. The total interest that you're going to pay, I figured it up, is $10,094. So you spent $41 on the price, but you end up paying $10,094 in interest. So your total cost was over $51,000, not $41,000. So here's the thing: 8.5% interest rate, but the total volume of interest, 24.6%. So every dollar that you gave the bank in payments, a quarter of that is interest. Over the life of that loan. Right? That's the game banks are playing. So it gets even worse if you were to do 72 months, so go an extra year. Total interest is $11,481. So now you're over $52,000, almost $53,000. 28% total volume and interest. So again, rate of 8.5% doesn't matter because it's really the volume that goes into that. So that's why we want to focus on using our policy and recapture that.
And this is just one way. And why the infinite banking concept is called the infinite banking concept. It is infinite, the ways that you can use this system. And I love working with investors. I love working with entrepreneurs because they've come up with ideas that I hadn't thought of, because they're each and every single one of their investments or each and every single one of their businesses are all different, but the philosophy is the same. As I start to describe and show them ways that they can use this, they're automatically thinking of the ways that they're going to implement it inside their everyday life. So, I think it was either last episode or the episode before, I threw out the number of 34 cents on every dollar that we earn is paid in interest. And this just proves the fact.
I mean, and this is just on a car.
That's just on a car. Exactly.
I mean, R. Nelson Nash in the book, Become Your Own Banker, he talks about, he's the one that really opened my eyes to volume of interest instead of the interest rate. Right. So I don't get too caught up on interest rates anymore. I want to look at, how much of every dollar that I send the bank is interest only. Right. So I'm getting nothing for it. So, so when we look at using a policy, or not just a policy, but when we look at buying a car, right? So you bought a car, I bought. Shoot, we were talking about how many cars have you owned before we hit record, and
I thought I had a lot.
Yeah, you were up to what, 6 in your lifetime, 6, 7?
Well, between Allie and I, since I've known her, I think we were at 12.
12
between the two of us.
You're just a baby. You're just a baby. No, so cars are kind of our weakness. We like nice things, and we don't tend to stay content with what we have very long, especially in our cars.
Well, they change the body style every 2 or 3 years, right?
And then you have to get the new body style. It's just a must.
Yep.
Now, we haven't had new cars. Honestly, the cars that we have right now, those are the first two, one for me, one for Ashton. Those are the first two that were brand new. That was a cool feeling, right? But before that, we've never bought. The closest thing to a new one is a truck I bought right after I joined the military, and it was 1 year old and had 11,000 miles. So other than that, I was always that buy the used, let somebody else take the depreciation. And then honestly, 2020 hit, and then we saw the inverse. I mean, you were much better off to buy a brand new car than a year, because they wanted more than MSRP on the used cars. So that was the weirdest thing I ever saw. But, I think we're getting back to normal on that. So, but when it comes to buying a vehicle, there's three different options really that we can do. I guess fourth if you consider a lease, but you're renting the car. And I get it. That probably has its purposes and business and everything. But when we're talking to people that are, for their personal lives and everything, it's just their daily driver or whatever, and they don't have a business that they're running this through or anything like that, then there's really just three options. And the options basically break down as you can pay cash. Right? And if you do pay cash, you're going to lose the ability to earn interest on that money forever. It's gone. The second one is you can finance the car, and then the interest is now getting paid to a third party, the bank, right? Or there's a new way, right? Well, not necessarily a new way, but there's a different way than the way that we like to do it. And it's where we're going to use our IBC whole life policy, right? And when I say IBC whole life policy, I don't mean that that's especially, like the name of the policy. It's just infinite banking concept. We're going to use that concept with a dividend paying whole life policy. Right. So that way we get to do what we talked about in the last episode, where we can create a tailwind and recapture all that interest and everything.
Exactly.
So I know, and we'll throw this up on the screen. So, of those that are watching on YouTube, those that are on Spotify, they can see this in video format. If you're listening on Apple Podcasts, sorry, they don't have video format at the time. But if you want to see what we're actually getting ready to cover, I'll throw it up on the screen here, and they can walk right through it. But why don't you break down the scenario of when you and Allie bought a vehicle and how you went about doing that?
Okay. Well, so to go back to mid-August of 23, it was just time to replace the vehicle that my wife had been driving. The old Tahoe had 200,000 miles, and we knew it was going to happen at some point. So that's a great place to be, and we can talk about margin, I think, on the next episode. But not having to be forced to make a financial decision is the best way to be when it comes to your finances. Absolutely. And so we'd been saving money, knowing that at some point we would be purchasing a new vehicle. Just knew that the Tahoe was going to give out at some point. And so we'd been saving money inside of a whole life policy for a while now. I mean, it's been years that we've been using this concept. And so with the valuations, I always look, and like you said, there's three options. You can pay cash. The issue with that is now you've given away that amount of money, and you can no longer earn interest, compounding any interest at all for the rest of your life. So I knew, first and foremost, I'm not paying cash for this vehicle, okay? After trade-in, we had owed roughly, we would be owing, or would have to pay about $48,000. So we went, got the vehicle. I go ahead and go sit down in the finance department there at the local GM dealership. And Allie goes, "What are you doing?" Because she knew exactly how we were going to pay for this. But she goes, "Why are you sitting down with these guys? This makes no sense." I said, "Well, I want to prove a point because I want to show my clients, hey, here's the options." And so I sat down with GM. I wanted to hear, what's it going to cost me to finance this thing? And I'm looking down at my numbers here so you guys can see, and I want to share the exact numbers. But in August of 2023, the interest on a brand new vehicle, even with our credit, was 8.19%. And I said, okay, we'll run the numbers. What's that going to cost me a month? What's it going to cost me total payback? All those type of things. And so these are the numbers when it comes to this. But the awesome thing with using the infinite banking concept, I'm going to show you guys how, with a vehicle purchase, we literally will earn, if we take this loan for 6 years, because this is another awesome option. I may decide to pay this loan off tomorrow if I choose to. But I'm basing these numbers on if I was going to finance it in my own personal banking system as I was going to against GM
Yep.
for 6 years. But we'll actually earn just under $6,700 in interest by using this concept that a lot of people haven't heard, because it isn't new, but a lot of people haven't heard about it. And so option number 1 was paying cash off the table right away. Option 2 is purchasing with a bank or through GM Financial. And so if you do the math, $48,000 at 8.19% for 72 months, the total repayment is $60,916.32.
Yep.
Okay. And so the total interest repaid on that $48,000 purchase is just under $13,000. It's $12,916. And quick, easy math, as you look at that, that's right about that 24% mark that you threw out at the beginning of the show. And so monthly payment of $846.06. So I actually took that deal. And like I said, Allie's like, what are you doing? Well, I knew that we had the money inside of a whole life policy. And the second I got home, I called the insurance company and said, hey, I need a loan for $48,000. And of course, as we always share, the 2 questions I got, okay, where do you want it? Because I told them how much I wanted.
Yep.
And so I told them no rush. Within about 7 days, I had it in my checking account. So when the first payment came in for this vehicle, I just wrote them a check for $48,000, completely paid off my GM Financial loan. What I did was...
I bet the dealership hated you.
I don't know. I haven't talked to them.
A bought back loan.
Well, I think they probably like me because we bought a few from them. So, but the great thing is now I transitioned that loan from GM. I transitioned it over into my own banking system. Not on top of, and I know we don't always want to talk about interest rates, but inside my banking policy, I have a guaranteed flat interest rate of 4% for the rest of my life.
Yep.
So if you're caught up, if you haven't completely bought in yet, but you're caught up on interest rates, that's under half of the interest rate.
Yep.
Okay. So let's do the math. 48,000 at 4% interest for 72 months. The total repayment now is $54,069.84. So that's just under $6,100 less in interest over 6 years that I'm paying back to the insurance company.
Just because you moved it from...
Because I transitioned it over from a loan from GM to a loan with the insurance company.
Yep.
Okay. So right there, I've saved tremendously, almost half in terms of interest paid. I'm going to be a very good banker. Okay. We can get into banking terms and all that on other episodes, but we teach every single one of our clients to be a good banker. And if I was going to have to go pay GM $846.06 a month for 6 years, I'm going to pay that back to myself.
Yep.
Even though my interest rate is lower, I'm still going to pay that back to myself to replenish the bucket of cash to implement this system again and just recycle the same amount of money. And so not only did I save, the $6,100 in interest, but here's the cool thing. I didn't borrow my money. My money has stayed inside my own insurance policy that I started long before, and it is continuing to earn interest.
Like we talked about last episode, you actually borrowed the life insurance company's money in their general fund.
Yep.
And you collateralized that loan against your cash value that was growing, uninterrupted, compound interest for the rest of your life.
Correct.
And that's the power of this.
Yes.
This whole system.
Exactly. But the cool thing is as I'm making payments, the interest paid is going to be decreasing. And again, that's flat interest. And we could probably have an episode on this too, the difference between that.
It's different than compounding.
It's so much different. So if we do the other side of this equation with my cash value inside this policy, so $48,000 at 4%, but this is compounding interest. I'm paying flat interest. I'm earning compounding interest.
Yep.
Do that math. Our $48,000 here in a couple years, right? Because we did this almost 2 years ago. Mm-hmm. So here in 4 years, our $48,000 in cash is going to grow to $60,735.31. And we didn't do anything outside of let it sit there and let the insurance company go out and pay us a dividend.
Yep.
And so if we do the math in terms of if we take this loan out for the full 6 years, we earned a little over $12,000 in interest. We paid a little over $4,000 in interest. And if you do that math, the positive interest earned, and this is tax-free, is $6,665.47. And so this is the power of using a high cash value, dividend paying mutual insurance company to partner with when it comes to your cash.
And that's just on one vehicle.
That's just on one vehicle. Exactly. Now, I don't know how many vehicle purchases the average person makes.
We're not.
You're way above average. I'm probably closer to average. But for a lot of people, they love the thought of paying cash for vehicles. My parents being one of them. Okay. My mom and dad, they hate car payments like the rest of us do. Their thought is, I'm just going to go pay cash. But I've talked to my dad about this thought process, and I said, Dad, do you understand how much money you are leaving on the table that you've given away for all these years? So for Allie and I, when we found this concept, we go, well, this makes complete sense. We can still not have a loan with a traditional bank, but we can make our cash grow exponentially. And so like you mentioned, this is just on one car purchase. Now, let's say 6 years from now, when I was driving over here, I thought about this. I'm like, well, we're just going to tell them of doing this one time. Well, what if we do this in 6 years, right? With the amount of miles we put on a vehicle, it's probably going to be time to replace this one in 6 years from now. So let's do some more figuring here. So in 6 years, we're going to have the $60,735. Okay. Now, instead of borrowing 48 that I had 2 years ago, now my cash has grown to where I could borrow $60,735, which, I don't know, vehicle prices will probably go up, and I'll probably have to dig into some of that $60,735.
But you're still in a lot better position than if you just would have paid cash.
Exactly. And this isn't even talking about the trade-in value and all those type of things of the vehicle that we're driving now. And I mean, it's still going to have some monetary value whenever we go to trade in. But this is the numbers. So if I looked, because I don't know what interest rates are going to be, in the future. But right now, on a brand new vehicle, the cheapest interest rate that I could find from a down the street bank here in Wichita, Kansas was 5.35%. So just even giving them benefit of the doubt will drop the interest rate, okay, from 8.19 to 5.35, and let's see how the numbers work out.
Yep.
So $60,735 for 6 years at 5.35%. My monthly payment at a traditional institution is going to be $988.02. Okay. The total interest paid is $10,402.44.
So not 60,000, but you're talking 70,000, almost 71,000.
71,000. Yep, a little over 71,000. Okay. Now, if I went and did the same thing, got the financing through GM again, went home, called my bank, hey, I need my $60,000. They send it to me, pay it off. We transition that loan over to a loan with the insurance company. This is the cool thing. Contractually, my interest rate cannot go up for the rest of my life. Yep. It is going to stay at 4% flat interest. So let's do the figures. And I wanted to just see if I did that, the monthly payment would be $950, but I'm going to be a good banker and I'm going to do $988 because that's what it would be out in the market.
Yep.
Right? Mm-hmm. So I want to always be a good banker. The total repayment is $68,415. Okay. So I saved in interest like it before. But the cool thing is my money has continued to grow inside my IBC policy. Mm-hmm. This is the powerful part of this. My 60 at 4% compounding interest over 6 years will grow to $76,849.
So what you originally started at 48,000.
Yes.
2 cars later.
Yep.
You have almost 77,000 sitting in your policy.
Exactly.
And that's without the extra interest that you're paying on top. Because there's going to come a point where, you're paying yourself more than what it costs you to borrow the life insurance money. Mm-hmm. So you're going to max out your cash value and get back up to 100% cash value of where you're at. So you got to figure out. Then you get this weird problem where it's like, okay, I want to continue to be a good banker, but I need to get some of that money out of there and go put it in the market somewhere and have an investment going. so I have room to make these extra payments back. That's a good problem to have.
It's an awesome problem to have.
Yeah, because then you could put it into the market, start making some dividend payouts and all that, or buy some real estate and have cash flow coming in, and then just again that cycle that we were talking about last.
Deal. So exactly.
Now let me ask you this: talking about just listening to you talk about your process, do you find it beneficial to go ahead and get the loan from GM and then just pay it off right away, or would you even need to do that?
No, we don't need to do that. I guess I didn't even know if that day we were going to purchase the vehicle.
Yeah.
But we wanted to leave that day with it, and that was the only way. I mean, they're not going to, let me take it home and then say, hey, here in 7 days I'll bring you the cash. That wasn't going to work.
Now, if you got a good relationship, could you buy more cars?
I guess.
So the car my wife had before her Yukon, right? It was a Jag F-Pace. Yeah, it was the SUV.
Okay.
Yeah, because the F-Type is the convertible sports car. But, we had a good relationship with them and everything. And I just explained, hey, we have this policy and we just need to transfer it. It takes typically 2 to 3 days. So they just had me write a check, right? And for the deal, and they said, hey, we'll just hold on to your check. Just text us or call us whenever the money gets into your bank account. That's what we did. We drove it home the same day. But I used the money from the policy and just wrote them a check.
Yeah.
So that was that was a year and a half ago. Yeah, something like that. That was the first time we ever paid cash, right? Now through our policy, but ever using this policy and then making the payment back to ourselves. That was the best experience I ever had when buying a car. And because every other time you're sitting around, you're waiting. I noticed in your example, you even pointed out we have great credit. And so I'm looking at, I actually came across this the other day. People our age, average credit score in 2024 for millennials, 691. That's the average.
Okay.
So when you're talking you have great credit, the average is not considered great. 720 is considered great.
Yep.
And then, just think of the people that don't have. I mean, they're getting hit with 15, 16, 17, 18% rates. So that compared to a 4% rate to the life insurance policy or life insurance company, that's huge in itself.
That's huge.
So now this is a great process. We've once the light bulb goes off, right? Because it's hard to wrap yourself or your mind around this process. Because like you said, not a whole lot of people. It's not new. R. Nelson Ash came out with it years and years ago, but a lot of people don't know about it. And once you do implement it and you see, the whole 360 circle of how this all comes around, man, and the light bulb goes off, it's like, okay, what else can I do?
Yep.
What else can I use this policy for?
Exactly.
Right.
And this is a liability. A car is a liability. This is not bringing in any additional revenue or an income or nothing inside of our household. This is a strict liability. Imagine if you use this thought process like a lot of our clients do and buy an asset that's actually creating cash flow. It's even more of a game changer.
Yep.
So this is for a liability, and it's still a benefit to use this process, not even with an asset.
Yeah, the cool thing is when you can borrow money from the policy, go put that in the market and make cash flow, right? Make a positive rate of return, and you create cash flow, and then that cash flow is what pays back the loan on it. So you're earning inside the policy uninterrupted compound interest, right? Compound growth, tax-free. It's protected, everything like that. But you're also earning a rate of return out in the market. Your money is working in two different places at the same time. And it's like, okay, how much of that can I do? Right? If it's always a positive, man, it's just a never-ending loop. Right? And so that's the cool thing. Well, I appreciate you sharing this this example with me, or I guess with the people that's listening, because it truly is a powerful deal. So if you have any questions about it, feel free to reach out to us. I mean, we love talking about this and how you can implement this in your life and everything. Next episode, we're going to talk about creating margin in your life. So here's a statistics. I just started doing research for the next episode, and according to bankrate.com, so they do an annual study, right? Their annual study found that 59% of Americans in February of 2025 don't even have enough to cover an unexpected $1,000 emergency expense.
Sad.
$1,000.
Yep.
So 60%. So every 10 people you see out there in the world, in America at least, 6 of them can't even cover a $1,000 emergency fund.
Yep.
Or not a fund, but an emergency expense.
Yep.
So we're going to talk about next episode how you can implement the system and how you can start creating margin, right? Some cushion.
Yep.
Life doesn't always have to punch you in the face. I know Dave Ramsey calls it Murphy's Law, right? If it can't go wrong, it will go wrong.
Yep.
Right? But we can take some steps to really, create some cushion and protections in our life to where we can handle those expenses that come up unexpectedly. Yep. So if this is something you're interested in, we'd love to hear from you. Please leave a comment in the, I guess below. Not in the description, but comments below.
Yep.
Please like, share, whatever. If you just share this with just somebody that you think you might like it, that would mean the world to us.
It would.
So we're always looking for new subscribers. We'd love to hear from you. So please comment below. If you got any questions, reach out to us. You can go to wealthwithoutstress.com, hit the contact button, and reach out to us if you want to talk directly. So, Jason, anything before we call this one?
I think that's it. I think the numbers speak for themselves.
Awesome, man. Hey, well, I appreciate you co-hosting this and not just coming back and having you on my podcast. So, but until next time, guys, we'll see you.